Greetings, finance aficionados. In this video, we're going to work through problem number 21 at the end of chapter 10. This problem involves bond pricing with semi-annual analysis. In other words, the coupon payments are paid semi-annually. But let's read through it. Heather Smith is considering a bond investment in Locklear Airlines. The $1,000 par value bonds have a quoted annual interest rate of 11%, and the interest is paid semi-annually. The yield to maturity on the bonds is 14% annual interest. There are 7 years to maturity. Compute the price of the bonds based on semi-annual analysis. Before we start working on the problem, let's make sure that we understand all of the terminology used here. The $1,000 par value bonds refers to the face value of the bonds, which is also the maturity payment at the end of the bond's life. They have a quoted annual interest rate of 11%, and the interest is paid semi-annually. So both the face value, the par, and this coupon rate of 11%, or the stated annual interest rate as they mention it, is 11% annually, but it's paid semi-annually. In other words, every half year. These are conditions that are established in the bond indenture. In other words, the legal paperwork that establishes the bond, the loan papers, if you will. The yield to maturity on the bonds is 14% annual interest. Now, the yield to maturity is the same thing as the investor's required rate of return. That is set by the marketplace, by the investors. So we see a difference here between what the bond is paying and what investors want. And there are 7 years to maturity. In other words, in 7 more years, the bond has to be paid back in full. At that time, the $1,000 face value will be paid by the company back to the creditors who loaned the company that money. Compute the price of the bonds. All right, let's do it on the BAII Plus, and the first thing we always do is clear out all of our time value memories. And we're going to use the time value memories here just to make a point that the price of any financial security is the present value of its expected future cash flows. And with a bond, we pretty much know what those cash flows are going to be. So we'll clear it out. Second, clear. We'll go up to the problem here to see what we have. The $1,000 par value is also the maturity value that's paid upon maturity at the end of the life of the bond. So that's going to be the future value. So we'll type in 1,000 and then put that under future value. The bonds have a quoted annual interest rate of 11%, and the interest is paid semi-annually. So the stated rate of 11% determines the dollar amount that is paid to the lenders, to the investor, every 6 months. It says semi-annually, every 6 months. The amount is 11% of the par value. So 11% of 1,000 is 110. So if we type in 110, but we have to divide by 2 because it's paid every 6 months in 6-month installments. So that's going to be the payment amount. The yield to maturity on the bonds is 14% annual interest. Well, that 14%, that yield to maturity, is what we use as the discount rate. But because this is an annual amount and our discount periods are semi-annual periods, then we have to divide this annual amount in half as well. And so 7 will be our discount rate. There are 7 years to maturity. But remember, the coupon pays every 6 months, so that means there are 14 discount periods remaining. So 14 is going to go under the N. And now we can compute the price of the bond. Click Compute, present value, and $868 and roughly 82 cents. And that's the price of our bond. So a couple things to observe here. One, the most important thing really, is that this $868 is less than the par value or the face value of the bond. The market rates went up from what was stated in the bond, and the price went down. The yields went up, and the price went down. This inverse relationship between market interest rates and the price of a bond, indeed the price of stocks as well, but more so we can see it here with bonds. That inverse relationship is really, really important, probably one of the most important things you can remember about pricing of securities. As market rates go up, the present value of that security comes down. Conversely, if our market rates were to go down, the price would go up. That inverse relationship between market rates and the price of the security is really important to remember. Again, when we're looking at these time value calculations, remember that this minus sign here does not mean below zero. It simply means it's an opposite direction of cash flow from what we put in here. So that's how we price a bond using the BA2 Plus calculator.